Thanks for tuning into the Mutual Fund Show. I'm Niraj Shah. Over the next 25 minutes, we are going to do something which is not normally what we do at the end of the year, which is try and talk about the schemes which have done well. But let's try and talk about underperformers and what is it that schemes which have not been able to do well in the last 12 months. Is there a chance that there could be upsides there? Are those themes per se suited for investing in as a category? For example, large caps. Are large caps good to bet on? And if so, what is it that and where is it within that you bet on and why? I think we'll talk about all of this over the next 20-25 minutes. But I start off with the disclaimer that if you're investing in the mutual fund space, do not invest with a 1 year time horizon. Do not look at the last 1 year and try and take an investment decision about whether a particular fund or a category is good or bad. I think these should be viewed over a longer period of time. With that, I'll still do what we shouldn't do, which is talk about the year with both of our guests. Prableen and Rushabh join in. Both of you, thank you so much for taking the time out. We keep on saying that this is not how funds or stocks should be looked at, but we still talk about that a little bit simply because the audience still takes some of the decisions based on those. So let's try and make the most try and give them the best advice, and which is why I've invited both of you on the show. Thank you for taking the time out. And Prableen, I'll start with you. Large caps as a category, underperforming for a while. Enough portfolio managers tell us that now is the time to bet on large caps. Trying to understand if you, from a mutual fund perspective, also believe the same.
Thanks, Niraj, for inviting. Great to be here. Yeah, absolutely. Large caps, I think the SPIVA report over the years has given us, enough data that actively managed large cap funds have been firstly underperforming the benchmark index, and the underperformance is as high as 80 to 90% on a 2-year, 3-year basis. It drops down to about 60% on a 10-year basis. And if you just look at 2023 H1, the first half of the year, it was about 50%. So definitely, I think the first point here is that active large cap funds as a category, generally the 30 funds that we have are struggling to, number one, beat the index because of the change in the mandate and the restricted universe that we have. Secondly, of course, large caps as a category and, the space, the top 100 stocks haven't done that great this year, 2023. The big companies, like the SBI, Infosys, HDFC Bank, you look at Kotak Mahindra Bank, all of them have returns, in the range of 2 to 5% year to date. But of course, within the large cap space, we've also had the companies like, Tata Motors and NTPC and all give phenomenal returns. So I think overall, large caps are, poised to do well probably in the coming year. Enough data for that as a category that, they can be high inflows, the risk-reward relationships are favorable. But from an investor point of view, I feel that within large caps, when they're investing, again, should they be taking the active route for investment? That is the trouble where we are seeing a huge divergence in the returns. So best performers giving you about 26 to 28% year-to-date returns, and the worst performers giving you about 14%, barely beating the benchmark. So I think that is something that investors have to start thinking about. That going forward, post the recategorization that was done, it's almost been 5 years. What is more apt for their portfolios, and if they're currently holding large cap funds, active large cap funds, should they exit or should they, stick to them, because they are again following very diverse strategies.
And there are options available, Rushabh, for people who want to play the large cap space but don't want to use funds, because as you've remarked as well, 70% of the active large cap funds have underperformed the BSE 100 TRI in the not just 1, 2, 5 years, but a long period of time. So is this optimism around large cap funds justified? Would you recommend to your clients point you to large cap funds, or would you tell them to look at other alternates while they might be bullish on large caps?
Niraj, first of all, thank you so much for having me on your show. I'm really loving the new avatar of NDTV Profit. I wish you and your team all the very best, that you guys break all the records going forward. As you correctly pointed out, and as Prableen also explained it quite well, that yes, large cap active large cap funds are definitely struggling. I pulled out some data, 70% or close to 70% of active large cap funds have underperformed BSE 100 TRI index over 10-year period. So 10-year is actually a very long period of time. Although we have been seeing that large caps have started to do well in 1 or 2 years time frame, but it's still not justifiable, that is such a long tenure in that space has to underperform. So there are two things, Niraj. One is that underperforming the benchmark and large cap as an overall market cap not doing well compared to mid and small caps. So we have seen over the past 1 year that mid and small caps have rallied tremendously. Comparatively, in terms of price and valuations, large caps have not performed well. So I feel going forward, large caps has very good upside potential compared to mid and small caps. But when we look at underperformance, right, like not giving outperforming returns compared to the benchmarks, active large caps are definitely struggling. As Prableen also mentioned that the universe is also limited. There are only top 100 stocks. Also, I would like to add two more points. The reasons for underperformance is that, there can be low portfolio churn. We have seen a low portfolio churn in the large cap space. And also over the past 3 years, growth strategy has underperformed as well. So combination of all of this has made active large cap funds not to generate alpha or outperformance. I think in my view, this is a good time to look at passive large cap funds, which is the Nifty 50 Sensex plan, and also one more space which has come up over the past few years is the smart beta segment. Now there is some insightful data what I pulled out. The smart beta indices. I took out the 10-year daily rolling return of smart beta indices since their inception, right? So over the inception period, on a 10-year daily rolling basis, smart beta indices have delivered anywhere between 13 to 16% returns, okay? Compared to Nifty 50, which is delivered anywhere between 11 to 12%. This I'm talking at an average level. Now, if you see the outperformance strike rate also, the smart beta indices, particularly the large cap smart beta indices, has given close to 100% outperforming strike rate compared to Nifty 50. So in my humble opinion, I think I'm currently not recommending any active large cap funds to my clients at this point of time. Investors can look at Nifty 50 or Sensex plan. Also, smart beta can be a great product just to give a little edge, in terms of if someone wants alpha or outperformance. But again, smart beta will perform in cycles, so there is no guarantee, that the past performance will be the same. But historically, what we have seen that smart beta outperformance strike rate has been phenomenal, anywhere between 90 to 100%. So either traditional plans, index plans, or the smart beta products in the large cap segments is something what investors can look at.
Okay, so it's a straight no from Rushabh. Probably just wondering, the other aspect therefore of a large cap funds is that what should people do who might be existing investors, let's say in large cap, some of the large cap funds, and which are underperformers. So two-part question to you, Prableen. First, Franklin India Blue Chip, PGM India Large Cap Fund. Let's think about a perspective of somebody who's invested in these funds. These are amongst the top underperformers. The rates change every single day. The last time that we pulled out this data, these were amongst the top underperformers. What should people do with funds like these?
Right, Niraj. So I'll answer this in three parts. The first part is being that within the active large cap space, or any active space, in fact, there will be a philosophy which the fund manager or the fund house follows, and that will only work in cycles. There was a time, in fact, from 2017, 18, 19, when HDFC Top 100 was really lagging the space and in the space, and we were seeing Axis do phenomenally well, and the tables turned in. Of course, we are seeing a huge lag here by the Axis funds, and HDFC Top 100 today is amongst the top performers within the large cap. So number one, that Niraj, investors need to decide, do they want to stay within the large cap active space. If they want to, then comes the question if they need to stick to their own fund. But I think for any investor who has a 10-year plus horizon, being in this space and actively worried about are you in the best or the worst performer, I would agree that going the index way within the large cap space is a cleaner strategy. Having said that, now let's look at Franklin Blue Chip. Franklin Blue Chip in particular, I think had a little bad innings with too many the fund manager changes. 2019 we saw Mr. Anand Radhakrishnan move out. 2021 we saw Roshni Jain move out, and since last 2 years Mr. Venkatesh Sanjeevi has been managing this fund. It's a 30-year-old fund. It's one of the oldest funds in the industry. But again, within a broader framework of the fund house, every fund manager comes with his philosophy. And his philosophy, Mr. Sanjeevi's philosophy, has been slightly more growth oriented. And that's how he started moving the overall portfolio towards the growth stocks. And there were exits like Coal India and NTPC. These holdings were exited by the fund, which have actually done so well because we've seen value investing actually do better in the last 2 years. So for somebody who is already invested, I feel then give time, because he's just started managing this fund for the last 2 years. Growth strategy hasn't worked. So if you want to continue with this fund active within the active space, then I think, Niraj, another year, especially going through the cuts in the interest rate cycle, I think that is really important, giving the fund that kind of a time.
Prableen, sorry, just a quick follow-up, and we need to slip into a break after that. But should people stay invested in a fund, in a large cap fund in the first place? And within that, if so, are there better choices within that universe relative to this underperforming fund? That's my question. Let's assume the viewer doesn't know whether she should stay invested in Franklin or no, and is wanting to know what are the options.
Yes, I would say continue to stay invested till the time, we are seeing the reversal in the interest rate in terms of interest rate cuts. Give it another year and a half. If it's still underperforming, exit. And overall, should they be in the active large cap space? I feel that if you've not invested in the large cap, it's of course a category to be in. But going forward, 10 years plus horizon, choose a passive fund, definitely.
Okay, and then that's the larger advice. Sorry, Rushabh, just before we take that break, but Rushabh, we need to slip into a break. So quick 30-40 second answer. PGIM is the other one as well. You may have a view on the Franklin fund as well. But I know your overarching views don't be in large cap funds, even though you might be bullish on large cap. So if somebody's invested here, should she or he exit these investments?
See, PGIM is following a growth-oriented strategy, Niraj, and we have seen growth-oriented strategy underperforming over the past 2 to 3 years, right? So if they are in profits at this point of time, right, and if they have crossed over a year, I think just exit and switch to a traditional passive fund or a smart beta fund in my view. But if they have not crossed a year, and if they have just invested, say, 6, 7, 8 months or so, and if they are not in profits, and so just wait for your fund to come in profits and wait for the fund to cross the 1 year time frame and exit and switch to a passive fund.
Okay, viewers, for some of you who are invested in these or some others, but essentially these two funds are the large cap category, I believe you got some advice from both our experts. There seems to be a consensus or near consensus in most aspects. Could that be the same in Flexi Cap? I think that's the other category that we talk about on the other side of this very quick break. Stay tuned to NDTV Profit. Back with the mutual fund show right here on NDTV Profit, in conversation with Prableen, Bajpai and Rushabh. And it's interesting because about a 12-month ago period, Rushabh, I'll start with you on this. People used to say that if you want to buy a large cap fund, but don't believe that there is enough appetite, then go for a flexi cap fund, because flexi caps have a dominant exposure of large caps. So you're in effect buying a large cap fund with some bit of beta provided by mid caps or small caps. So I just want to understand, as a category, flexi cap, what's your sense for 2024, or somebody investing into 2024, whether from a 12-month or a 60-month perspective is a different picture altogether?
Niraj, I think you correctly pointed out, like many flexi cap funds are inclined towards, more inclined towards the large cap space. Through this channel and through your medium, I would like to really urge, the fund managers and the AMCs that, flexi cap funds really need to be true to their label, that's the reason why we have multi-cap as a category now. But, comparatively, if you see, flexi cap as a category has done fairly well. Only 40% or close to 40%, flexi cap funds have underperformed. Now, the beauty of flexi cap is that, they can invest not only in India, but abroad as well, say like Parag Flexi Cap Fund, which has the liberty to invest in the US markets as well, right? So in my humble opinion, I think flexi cap funds would be well suited, especially true to label flexi cap funds would be well suited, for investors who are a little bit on the high risk side and have a longer time horizon. But specifically for 2024, I mean, see, we all advise, go do long term. But specifically for 2024, I think because mid and small caps have rallied quite a lot, I think 2024 would be the year probably for the large cap segment to do well. So I think, again, don't choose a fund just because, it's inclined towards the large cap space or something, because flexi caps do have growth oriented strategy, value oriented strategy as well, right? And so it's very important to match the fund and the fund style with your risk and your time horizon as well. So in my view, flexi cap is still a very, very good category. I'm very much recommending flexi cap funds at this point of time. But I feel choosing a good blend, of growth and value styles will work out well, because we have seen over the past 3 years, value has done tremendously well and growth has taken a backseat. Probably going forward, when the Reserve Bank of India starts to cut the rate, probably growth strategy might pick up going forward. So I think having a good fund, good AMC, good having a good manager is very important, but at the same time having growth and value both in one's portfolio is also very important.
But I must say, over the last 10 years, if you just look at what some of the schemes in the flexi cap side have done, a good percentage or a decent number of schemes and the well-known schemes have been able to do reasonably okay on the XIRR or the CAGR front. So that's an interesting piece as well. Prableen, come in. This is no way comparable to what large caps have done, but is flexi cap a category to reckon with, or people who want a higher exposure to mid caps and small caps rather choose a multi-cap fund, or just segregate your portfolio out of the 100 rupees that you're putting in, choose where you want to choose a small cap fund, where a large cap fund, and then a mid cap fund separately?
I think, Niraj, we are at a time where any portfolio should be a mix of active and passive strategies. And if I have to construct a portfolio, I would choose a passive fund from the large cap and the mid cap space mostly, and, club it with a flexi cap or a multi cap. So flexi caps as a category, I think, is very relevant, and it can actually complement a passive strategy from the large cap space, because there is no scope for value investing in, indexing strategy. So I think flexi caps definitely, are a great category. But if you start comparing the returns, I feel as compared to, the benchmarks, the Nifty 500, I feel it would be hard for even the flexi cap funds to beat the benchmark, though they have a great potential as a category. They have the flexibility, but as Rushabh also mentioned, you've mentioned that majority of them are large cap tilted. So I think rather than having an active large cap and of course a flexi cap, which is again an active strategy, I think you should have one. So choose a flexi cap, and I think complement with a passive strategy from the large cap space, and I think that can work for most investors. And as far as the underperforming funds are concerned, Niraj, I feel that, it's the one line answer is that the growth strategy hasn't worked, value investing has worked, and that is why we are seeing the huge divergence, in the returns, and decent funds have really been beaten down in the last 1.5 2 years.
Okay, so then since there is a bit of a consensus that Flexi Cap as a category may do well, Prableen, let me come to you first. What to do with some of those underperforming funds? There is no rule that what is underperforming will continue or will bounce back as well. So if you looked at these schemes closely, and PGIM features there too, but UTI, PGIM, Axis amongst the top underperformers for 2023. Somebody's invested here. What to do if somebody wants to take advantage, wrongly I might add, that because these have underperformed, they might start outperforming. What does one do?
If you're already invested, Niraj, I feel that, have some more patience, give another year, I would say, give 2024 to your funds, all the three funds, in fact. And if they still continue to lag the benchmark and the category average, then definitely there will be a strong case to exit. But I think at a time when we know that there is, interest rate rise, the Federal Reserve's movement, we know the, geopolitical risk, everything, we absolutely know that the growth strategy didn't work. So at a time, exiting these funds, which totally thrive on that philosophy, would, I think, be harsh. Give them another year, and I think it still doesn't perform, then definitely UTI, Flexi Cap, PGIM India, and Axis, I think there will be a case to exit all three, but after another 12 months.
Okay, Prableen, just very quickly, quick 30-second follow-up. Why another 12 months? You would have made that argument maybe 6 months ago that let's wait for another 6 months and see, and it would have worked. So why this period of 12 months?
Niraj, because I think we are already at the peak of the rising interest rate cycle, and from here we may see some reductions in the interest rates, and growth strategy is something that may actually start working. We may see the return of FIs in the coming year, and a lot of these funds have these large cap stocks which have not performed. For example, Avenue, Mats, and then we have the HDFC Bank, and so many of these TCS, Infosys. So I feel that the quality of the holdings is not bad. There is quality, in the holdings of these funds, but overall there has been no movement, and they've struggled. So I think there is some case, for another year of patience.
Okay, Rushabh, are you being as kind?
Niraj, actually, all three funds are good in my humble opinion. All three funds, are following growth-oriented strategy, and that's the pure reason why they have underperformed, is mainly growth has underperformed. Now, actually, I just want to add in one more point here, Niraj. See, we all talk about exiting funds, not doing well. I think the key is to diversify well, if I minus the large cap as a category, right, and if I just take Flexi Cap as a category as well, what I would do is probably invest, 50-60% into Flexi Cap category, 20-25% into pure mid caps, and 20-25% into pure small cap. That is the best way to, mitigate your risk also and have a good diversification in your portfolio. That's the only way you can minimize, you can't completely avoid underperformance. That's the way you can minimize the underperformance from an overall portfolio level. So rather than, kicking out funds from your portfolio, if the fund, is managed by a good manager, backed by a wonderful team, right? I think, diversification is the key over here, to minimize underperformance at a portfolio level. So have separate funds, have Flexi Cap funds, have pure mid cap and pure small cap funds as well. That will really help, investors minimize, the underperformance risk from a long-term point of view.
Okay, well, we'll have to wrap it up on that note because we're out of time completely on the show. Maybe one point left undiscussed, but I think we broadly got a gist from both of you. So thank you so much for taking the time out and being with us and giving us your thoughts.
Thanks, Niraj.
And viewers, thanks for tuning in to yet another episode of the Mutual Fund Show.